Being a limited partner is a great way to invest in deals, especially as a busy professional, dentist, a doctor, or any other professional, as long as you know and trust the deal that you're putting your money in. So as a limited partner, you can participate passively in large-scale real estate while leveraging expert operators. You gain potential cash flow, appreciation, and tax-advantaged growth. Real estate adds diversification, leverage, and control that stocks alone cannot. The wealthy invest for cash flow and tax efficiency, not just paper appreciation or net worth. And finally, always do your... Welcome to the Doctors Investor Club podcast, where physicians and dentists come together to elevate their mindset, build their assets, and create a lasting legacy. I'm your host, Dr. Kyle Stephenson. After years in the OR, I've realized wealth is not just about high income. It's about ownership, freedom, and using your money with purpose. Here at the Doctors Investor Club, we share the strategies the wealthy already know: owning a business, real estate investing, becoming your own banker, and intentional investing. Each week, we sit down with entrepreneurs, investors, and physicians who've stepped off the hamster wheel and are building wealth that outlives them. Because at the end of the day, it's not about how much you make, it's about how much you keep and the impact you leave behind. Let's get into today's episode. Welcome back to the Doctors Investor Club podcast, where we help physicians and dentists learn how to think more like the wealthy. I'm your host, Dr. Kyle Stephenson, orthopedic surgeon, investor, and someone who's passionate about helping doctors take control of their financial future. Today, we're diving into one of the most powerful and often misunderstood wealth building tools out there, becoming a limited partner in real estate syndications. We'll talk about what that actually means, how it works, and why it can be such a game changer for busy professionals. We'll also touch on the tax advantages, how to keep your capital compounding through what I call the lazy 1031 exchange. And I'll share a personal story, including a painful lesson I learned early in my investing journey that completely changed how I evaluate deals today. Before we get started, this podcast is for educational purposes only and should not be considered financial, tax, or investment advice. Always consult a licensed professional before making investment decisions. Past performance does not always guarantee future results. All right, let's jump in. So first, let's break down what it actually means to be a limited partner, or LP, in a real estate syndication. Think of it like this. You're pooling capital with a group of other investors to buy something substantial, maybe an apartment complex, a medical office building, or a self-storage facility, among other asset classes. Could be residential assisted living, could be RV parks. The deal is run by an experienced operator that are known as the general partner, or GP. They find the property, they negotiate financing, manage renovations, handle tenants, and eventually sell the asset. Your role as the LP, or limited partner, is simple. You provide the capital, and in return, you share in the potential profits and tax benefits. Your liability is limited to your investment. You're not personally on the loan or responsible for operations. You're not dealing with tenants or repairs, and you're not dealing with the dreaded 3 T's of being a landlord: toilets, tenants, and trash. You're leveraging someone else's time, experience, and team while still owning a share of a physical, cash-flowing asset. Now, here's why this model makes so much sense for physicians, dentists, and other high-income professionals. We already work some of the longest hours of any profession. We don't have time to manage tenants or chase contractors. And trust me, I've been doing it for the last few years. I have single-family homes and Airbnbs and small multifamily that I've been working on the last few years and trying to get out of. But we don't have time to manage tenants or chase contractors. It's not fun, and it's definitely not passive. That doesn't mean that we can't participate in real estate, however. It just means that we have to do it intelligently. Syndications let you invest passively in institutional-grade projects, the kind you couldn't or wouldn't buy alone. And you still get many of the benefits of real estate ownership: appreciation, ongoing cash flow, and favorable tax treatment, such as depreciation. For me, it's about freedom. It's about letting my capital work while I'm in the OR or spending time with my family. You get to grow wealth without trading more time for money. Now, a question I get all the time: why not just invest in index funds and let it ride for 30 years? And honestly, that's a fair question. Index funds are great. Diversified, low cost, historically strong performers, and I still invest in them as well. But here's the thing. Index funds build net worth on paper. Real estate builds income and equity. When you invest in the S&P 500, your wealth grows if the market goes up. And to access it, you often have to sell shares, which means you're slowly reducing your principal and you're paying capital gains. In real estate, you can receive periodic distributions while your equity continues to grow. And thanks to depreciation, much of that cash flow can be tax deferred. You then get the bulk of your profits when the property sells or the team does what's called a cash out refinance and you stay in the property. Plus, real estate offers something the stock market doesn't: leverage, the ability to control a larger asset with a smaller amount of capital. Think of it like when you're buying your own home. When you buy a home and you have a mortgage, you put 20% down on your home and the bank lends you 80%. Same thing with this. So it's not either or, it's both. Index funds for long-term liquidity and growth, real estate for diversification, cash flow, and tax efficiency. Here's how I think of it. Middle-class investors save to retire someday. Wealthy investors invest to create income now while still building wealth for later. This brings me to one of the biggest mindset shifts I've seen among doctors, and one of the reasons many never reach true financial freedom. The typical middle-class portfolio often looks like 90% in paper assets like stocks and bonds, 10% in a home or savings. The wealthy, though, think differently. Their portfolios often include 30% in private businesses or private equity, 30% in real assets like real estate, energy, or infrastructure, and the rest in public markets for liquidity. So they really only put about 29 to 30% in the stock market, whereas the middle class is putting about 90% in stocks and bonds. Now, these aren't hard numbers, they vary, but the principle holds. Cash flowing private assets and tax optimization drive durable wealth. So when a doctor reallocates even 10 to 20% into passive real estate deals, it can change their entire financial trajectory. Now, let's talk about the part that gets everyone's attention: the tax benefits. I'm no CPA, so talk to your CPA and give them, this podcast to listen to, and they can verify for you. But real estate offers a unique tool in the tax code called depreciation. So even though your property will appreciate over time, there's something called paper loss or depreciation. So through a cost segregation study, operators can separate a property into components: roofs, plumbing, flooring, HVAC, appliances, landscaping, you name it. There's a lot of them. And they all depreciate at different ranges from 5, 7, 10, 15 years. And those things depreciate much faster than the typical 39-year of linear depreciation in commercial properties. So when you combine that cost segregation, when you combine that with 100% bonus depreciation, which did come back this year, January 20th, 2025, they put it back into play through the One Big Beautiful Bill. So when you combine cost segregation study with 100% bonus depreciation, investors may be able to deduct a large portion of their investment in the first year on paper. For example, if you invest $100,000, you might receive 50 to 70% of that, maybe even up to 80% of that. So $50,000 to $70,000 of paper loss or depreciation in year one. These losses can offset passive income, potentially making distributions tax deferred. And if you or your spouse qualify as a real estate professional status under the IRS rules, those losses might offset active income or your W-2 income or 1099 income. This depends on your individual situation and should always be reviewed with a qualified tax advisor. But it's one of the few legal ways to earn money while keeping more of what you make. I love that Robert Kiyosaki quote: "It's not how much money you make, it's how much money you keep, how hard it works for you, and how many generations you keep it for." So next, let's talk about recycling capital. So there's something called the 1031 exchange, which you'd have to look up, but it's basically you have to identify the property within 45 days and you have to sell and buy a new property within 180 days. And that's a bit of a tough ask, and you have to use CPA, and there's a lot of rules with that. So that's called a 1031 exchange based on the IRS code. All right, so now let's talk about recycling capital when it comes to being a limited partner. Now, there's something called the 1031 exchange, which is an IRS tax code. We're going to talk about the lazy 1031 exchange, all right? So what's the 1031 exchange? It's basically you can use it with a residential property, you can use it with a commercial property, and basically it's a lot of legwork to figure that out. And you have to use like an intermediary and you have to use a CPA, but it's basically you have to, when you have a property and you want to kick the tax the capital gains down the road, and you can, what's called defer, and die. Basically what you're doing is you have to identify your next property within 45 days, and then you have to buy that property within 180 days. So there's a lot of nuances to it. And that's the 1031 exchange. So when you do that, you have to buy a property that's of the same price, basically, or bigger, and you can defer those taxes to the next property. Now, this is called this is called the lazy 1031 exchange, that you don't have to go through all those hoops. Now, most syndications hold a property for about 3 to 5 years. When it sells, you typically receive your original investment back plus your share of the profits. The key is, don't let that money sit idle. You want to reinvest it. So I call that the lazy 1031 exchange. We'll explain it, but it's not an official IRS 1031 exchange. But functionally, you're keeping your capital in motion and continuing to defer taxes by redeploying it into new opportunities. So your initial capital usually comes back tax-free, since it's a return of principal. The profits, on the other hand, are typically subject to capital gains tax, which can be up to around 20% for long-term holdings. But here's the smart play. When you reinvest those profits into another real estate syndication within the same year, the new depreciation from that deal can often offset much or even all of your passive income from the prior deal. That's the essence of the lazy 1031, continually recycling your capital and resetting your depreciation benefits. Each new deal restarts a depreciation schedule, giving you fresh paper losses that help keep your income tax efficient. Over time, that's how you turn a one-time investment into a compounding income engine. One deal fueling the next, with your money always working for you. All right, so that's how you can use being a limited partner in syndications powerfully. That's how you can make it a compounding income engine, which is very powerful. And I love real estate syndications. I've been doing it for years, and I have a fair amount of money out there in real estate syndications. But I do have to tell you one personal story that I don't talk about often, because it's really not one of my proudest moments. But I just want to be vulnerable and let you know about this, because things don't always succeed, right? Deals aren't always what they seem to be. All right. And it's a valuable lesson that I learned in my investing career. So a few years ago, I invested in what turned out to be a Ponzi scheme. You wouldn't think, you see it in the movies and stuff like that, and you wouldn't think that it would happen to you, but it happened to us. So everything in the deal looked perfect. We trusted a referral. We put our money into basically him, but they had polished materials. They had confident operators. They had predictable returns, and the returns were very good. So I trusted a referral, and I didn't slow down to truly vet it. We trusted him enough, handed the money over, but I didn't visit the property. I didn't meet the team. I didn't get to see, the team eye to eye, shake their hands. I didn't verify the numbers. Eventually, that deal unraveled. We actually got about 5 months worth of returns, which is crazy. So we were riding high. We were feeling really good about it, until that dreaded email we got from the SEC telling us that we invested in a Ponzi scheme. Now, we weren't in trouble legally, but we did lose money. And so, fortunately, the money that we lost wasn't life-changing, but the lesson was priceless. And as physicians, we verify everything in medicine. We always verify labs, imaging, vitals. We look up everything before we go to the OR. We have a plan in place. We are very meticulous with our due diligence when it comes to medicine. Yet I failed to verify my investments, the money that we work hard for to earn, not just for me, but for my wife and my kids. That experience completely reshaped how I invest now. So now I personally walk every property I invest in. I meet the operators face to face. I ask uncomfortable questions. I don't invest in anything I don't fully understand. And I use the Dewey due diligence AI tool that we have with the Doctors Investor Club to help evaluate deals objectively. It also spits out about 7 to 10 questions that you can ask the operator on the deal. You can ask the operator personally about, themselves and their track record. Over time, I've also learned the importance of aligning with operators I know and trust. One example for me has been Hudson Investing. It's a firm I know personally. Their CEO, Kent Ritter, and I actually went to high school together. They're based here locally and have built a strong reputation for transparency and solid fundamentals. Of course, I always remind our listeners, this is not an endorsement or investment recommendation. It's simply an example of how I applied that trust but verify principle in my own journey. And like I tell my kids, when you win, you win. When you lose, you learn. And we did. We learned a valuable lesson. And no longer will I just trust the referral source or trust the operator even without going through my steps of due diligence. And that's why I, along with Richard Wilson, started the Doctors Investor Club. We want to help busy professionals invest with confidence, learn from each other, learn from people much smarter than us when it comes to investing. We don't know a ton about finances, so it's nice to learn from people who've made those mistakes, somebody that's been able to learn from that, correct it. And so we want to learn from people much smarter than us and really avoid costly traps, right? That was, luckily it didn't, ruin our investing or, ruin our lives too much, but it definitely took a toll, and it definitely made us think twice about investing in the next deal. So if you take one thing from this episode, trust but verify. So to wrap it up, being a limited partner is a great way to invest in deals, especially as a busy professional, a dentist, a doctor, or any other professional, really, as long as you know and trust the deal that you're putting your money in. So as a limited partner, you can participate passively in large-scale real estate while leveraging expert operators. You gain potential cash flow, appreciation, and tax-advantaged growth. Real estate adds diversification, leverage, and control that stocks alone cannot. The wealthy invest for cash flow and tax efficiency, not just paper appreciation or net worth. And finally, always, always, always do your due diligence. That's important. Again, learn from my last personal story there. Luckily, it's only been one deal, but if we didn't learn our lesson, that could have been obviously more. So now we use mentors. Now we have a group of other physicians and dentists that we can talk out deals together. They may bring deals to me, I bring deals to them, and we can talk it out and figure out what are the best deals to jump into. If you found this episode helpful, share it with a colleague or a friend, anybody who's curious about real estate investing. If you're a physician or a dentist, you can join our community and learn more at doctorsinvestorclub.com, where physicians learn to think like the wealthy. I'm Dr. Kyle Stephenson. Thanks for tuning in, and I'll see you on the next episode.
This is my time. I'm on the rise. Can't hold me down. I'm too fly. This is my time.
Thanks for listening to the Doctors Investor Club podcast. I hope today's conversation inspired you to think bigger, dream bolder, and take the next step toward financial freedom. If you're a doctor or dentist and you're ready to join our community, head over to doctorsinvestorclub.com. Our mobile app and forum are free for physicians and dentists. You'll find AI tools, curated investor resources, and live events. And if you want VIP access to private dinners, exclusive deals, and opportunities to speak on stage, it's free when you refer 3 colleagues. Subscribe to the show, share it with a colleague, and remember, you're not just building wealth, you're building a legacy.
Watch out, here I come. This is my time. I'm on the rise. Can't hold me down. I'm too fly. This is my time. Ready to shine.